Within a span of just 24 hours, the gold market declined by 9% in a single trading session, while silver collapsed by more than 35% in one day, an event without precedent in modern market history. Roughly $7 trillion in market value vanished within a single day. This occurred in the absence of any new inflation data, without a financial crisis, and without central banks engaging in large-scale selling. Instead, the market reaction was triggered by a political signal emanating from Washington. This raises a fundamental question. Was this merely a market accident, or was it a liquidity shock activated through policy power? And when gold, silver, and the US dollar all experience simultaneous turbulence, where exactly are we positioned within the global monetary cycle? From the moment the US trading session opened, price behavior no longer resembled that of a normal market. Gold did not decline in measured steps. It fell abruptly and continuously. Red candlesticks extended far beyond anything seen in prior corrective phases over many years. Across trading platforms, order book depth visibly thinned. The spread between bid and ask widened rapidly, as though the structural support beneath the entire market had been suddenly removed. Silver's reaction was even more extreme. Within minutes, familiar price levels disappeared, not because they were gradually breached, but because they were skipped entirely. Prices leapt downward into lower zones without intermediate transactions. This is an exceptionally rare signal, indicating not ordinary selling pressure, but an indiscriminate flight from risk at any cost. At that moment, observers would not have detected the usual signs of panic driven by negative news flow. There were no urgent inflation releases, no hawkish Federal Reserve statements, and no sudden geopolitical escalation. News screens were nearly empty. Paradoxically, it was precisely this absence of information that made the situation feel abnormal. The market was reacting to something that did not appear in headlines, yet was powerful enough to fracture price structures within hours. Prior to January 30th, both gold and silver had advanced a considerable distance without encountering meaningful resistance. Prices were rising faster than underlying physical flows. Futures contracts, options, and leveraged positions expanded aggressively, while base liquidity failed to grow at a corresponding pace. In effect, the market appeared robust on the surface, but was far more hollow internally than many participants realized. The true risk did not lie in elevated price levels themselves, but in the collective belief that those prices were inherently justified. When too many participants converge on the same hedging narrative, the market ceases to function as a hedge. It becomes a crowded trade. And crowded trades require only a minor disturbance to trigger a cascading collapse. Once the political signal emerged, the market did not pause to evaluate its validity. It required only a justification to reprice risk. The issue was not that policy had already changed, but that the perceived probability of near-term change had shifted. For positions built on assumptions of prolonged instability, that shift in perception alone was sufficient to destabilize the entire structure. As prices began to slide, the initial response did not originate from human decision-makers, but from systems. Automated risk management algorithms reduced exposure. Highly leveraged funds approached margin thresholds. Stop-loss levels clustered during the euphoric phase were triggered almost simultaneously. Each trigger represented not merely a sell order, but a signal compelling other systems to liquidate as well. Within minutes, the market transitioned from two-way trading to a unidirectional flow. Buyers did not vanish entirely, but they stepped back, waiting for price stability. Sellers, by contrast, had no such luxury. They required immediate liquidity. This temporal mismatch caused liquidity to contract sharply. At this point, many participants experienced a clear distinction between price and value. Prices fell not because gold or silver suddenly lost their fundamental appeal, but because there was no longer sufficient demand willing to act as a shock absorber. Under such conditions, each successive sell order worsened conditions for the next. While gold and silver collapsed, the US dollar did not surge in a dramatic panic. Nevertheless, it was chosen. Capital did not flow toward the theoretically safest asset, but toward the most liquid and readily settlable one. This distinction is often overlooked when discussing the dollar's role. In periods of stress, the dollar prevails not because it is flawless, but because it remains the core node of the global liquidity system. This dynamic produces an uncomfortable paradox. Assets purchased for protection become sources of short-term risk, while a frequently criticized currency becomes a temporary refuge. This paradox is not new. It has appeared in past crises, yet markets continue to respond as though encountering it for the first time. Closer observation reveals that the collapse was not evenly distributed. Areas with high leverage were affected first. Markets heavily dependent on paper trading reacted more rapidly than physical markets. This underscores that the shock did not originate from real supply-demand imbalances, but from the financial architecture layered atop the assets. It is here that the boundary between finance and politics becomes indistinct. No explicit orders were issued. No public statements instructed markets to sell. Yet a shift in expectations regarding policy power compelled the entire hedging pricing framework to adjust. Politics did not need to intervene directly. Altering the market's perception of risk was sufficient. History shows that gold has endured similar phases before. After the 1980 peak, prices underwent a prolonged adjustment. Following the 2011 peak, gold required nearly a decade to return to its prior real valuation zone. Each episode featured a different narrative, yet shared the same structure. Prices outran the cycle, confidence became excessive, and rebalancing became inevitable. What distinguishes the present episode is speed. Modern markets react far more rapidly than in past cycles. Leverage is higher, algorithmic participation more pervasive, and capital mobility far greater. As a result, corrections no longer unfold gradually, but instead concentrate into short time frames with extreme amplitude. Looking back at that trading session, what remains most striking is not merely the $7 trillion erased, but the sensation of liquidity being drained from the market almost instantaneously. It was a moment in which assumptions about safety were fundamentally questioned, not because they were incorrect, but because they were applied without regard to context. This event does not suggest that gold or silver have lost their long-term role. Rather, it demonstrates that such roles are not linear or simplistic. Under certain conditions, defensive assets can behave like risk assets when the surrounding trading structure becomes distorted. In such environments, a shock requires no dramatic catalyst. Markets do not punish belief. They punish blind confidence in a single scenario. When everyone occupies the same side of a trade, the greatest risk lies in the absence of participants willing to stand opposite. Those who followed that day closely will note that the market did not collapse amid chaos, but within a tense silence. There were no dramatic headlines, only numbers changing faster than participants could process. This form of volatility is particularly dangerous because it allows no time for reflection, only for reaction. This leads to a broader question raised by the episode. In a financial system where liquidity is prioritized over symbolic trust, what truly provides safety? Is it the asset itself, or the ability to exit that asset when conditions reverse? This question does not seek a definitive answer. It is intended to compel a reassessment of how gold, silver, and the US dollar are understood during periods of stress. Not to conclude, but to recognize that markets are invariably more complex than familiar narratives suggest. It is precisely in moments like January 30th, when events unfold too rapidly to be explained in real time, that understanding the underlying structural mechanics prevents participants from being swept away by collective emotion. This is why the $7 trillion decline matters. It does not indicate that gold or silver have failed. It signals that markets may be entering a new phase in which political expectations and liquidity structures can temporarily overpower defensive functions. Monetary history, from high inflation cycles to periods of policy realignment, shows that gold and silver preserve purchasing power over time, but not in straight lines, and never without exposure to shocks. The path ahead is therefore likely to be more complex, more layered, and more demanding of a deeper understanding of the global monetary cycle. And perhaps this episode marks only the beginning, as policy adjustments and capital flows gradually reveal themselves in the quarters ahead. How do you think this will affect gold, silver, and the US dollar in the next phase? Share your perspective. This is Money Cycles, where we examine the fault lines of markets. If you wish to continue following analyses of this nature, you know where to find us.